How'd you sum up the swings we saw today?
It was always a kind of a mild little follow-through rally, even at the highs of the day. And I think it's a little bit winded, a little bit fatigued after a 6% run in the S&P 500 right up to the cusp of a new high in just a few weeks. So I do think below the surface breadth was very mixed. I think you've lost a little bit of that initial oomph of, oh no, yields are turning higher. A lot of beaten down stocks are starting to improve. We better catch on to it. So I wouldn't take too much away from today's action in terms of saying that this rally is over, but you've gotten a lot in a short amount of time so far.
Shawn, what did you make to the fairly volatile reaction to this morning's macro data and central bank action?
It was pretty amazing. If you look at copper, which is a barometer of global growth expectations, we went from 259 to 267. That's a 3% plus range. So that's a really big range for what people's thought process of what's going on in the global perspective. So ECB came out. I think they underestimated what the market really wanted. We had a huge rally. We then turned around and went the other way just because we had dissenters. So there were countries came out and said that they didn't want to have QE. So really Draghi has put a unique position out there where he's saying this is going to last for an extended period of time with no cap. And the market is saying, no, I don't think that's going to happen. So it'll be interesting over the next 6 months what really happens at the ECB.
Stephanie, meantime, we had some data again today here in the U.S. that was perhaps a little better than expected. CPI reading that was hotter than expected. How does that set us up? You have the ECB here. You got the U.S. data here. How does that come together and set us up for the Fed next week?
I know, it's hard, right? I mean, 2.4% core CPI annualized. In the last 3 months, if you annualize it, core CPI 3.4%. So you can't really say that inflation isn't around, right? It is definitely here. And I think that's actually why the bond yields actually reversed, where they were down and then they reversed higher. And I think also the fact that the financials held in there was kind of impressive as well. I thought it was going to be a complete risk-off day. It really wasn't. It was a very mixed day. Certainly some of the growth stocks made a comeback, but a lot of the value stocks, a lot of the cyclical stocks also did quite well, which is also encouraging. It's broadening out the market as a whole. Next week, as I said earlier, I think the Fed is going to have dovish language, but maybe not as much so because you have a lot of data points here in the States that have been better. So 25 they go, and then a little bit of dovish, but not as dovish as people want.
Shawn, have you got conviction as to where you should be positioned in the bond market, whether here or abroad?
I think if you look at some of the opportunities that are out there, you look at five-year forwards as far as the U.S., inflation expectations are still going down and they're really at their lows. If you look in the U.K. right now, you have inflation expectations are actually rising. So 3.4% inflation expectation next year. So if you look at gilts, they're trading at 60-odd basis points. So that becomes an interesting short play out there. I think now it's just about relative value in the marketplace, but there is inflation that's working its way through the system. The question is you're going to have expectations change as far as future inflation, and then you'll start to see the market back up aggressively. Right now we're talking about 25 basis points in either direction, which is relatively benign. But remember 2016, when the market changes after a significant rally, it can move back very quickly. And I think that's potentially out there over the next 6 months or so.
So, Shawn, does that mean that you would be investing in precious metals or other safe haven assets right now?
Absolutely. I think you want to look at, certainly on dips, buying precious metals, silver especially, on an inflation-adjusted basis. Silver is actually very cheap and has a lot of room to run. It's caught up to gold as far as a percentage, but it's still lagging a little bit. I think you want to look at copper, and I think copper is a key indicator of what's going to happen as far as what people perceive as global growth. I think there's a fundamental underlying bid for equities at this point in time, and people want to get in them in any sort of positive news that's out there. So that's a trend that I think is in place. However, if we get back to a 2% 10-year, I think people will be talking about, oh no, equities are going to be in trouble. So it's still a tenuous rally at best.